All right, we are going to start today's session with a conversation with Robert Weber, Managing Partner at Great North Labs. Rob, welcome to the show.
Hi, thanks for having me today.
All right, let's start by introducing our audience to yourself, talk a bit about your background, and also to Great North Labs.
Sure. So my name's Rob Weber again. I live in the suburbs of Minneapolis, Minnesota. I just turned 40 years old. I started building my first software companies as a teenager in the mid-90s and successfully bootstrapped a company which became known as NativeX. At our peak in 2012, my twin brother Ryan and I, we achieved 70 million in revenue and 10 million in EBITDA. We had multiple exit events from this startup. The only money we raised was a small $320,000 angel round back in 2000, right in the dot-com bust. So we kind of learned a thing or two about resiliency, going through that recession, which is kind of relevant, I think, today. But when we had our first exit event at age 25, my twin brother Ryan and I formed a family office, began making early-stage investments into kind of local and regional tech entrepreneurs. And, once we exited the last of our operating business, we decided it's actually been 3 years ago, to launch our debut fund, Great North Labs, with partners. So it's a $23.7 million debut fund. We focus investing in startups that are headquartered in Minnesota and across the kind of Great Lakes, upper Midwest region of the U.S., although we can invest anywhere. We typically make our first investments in startups during their seed rounds with a check size ranging from $250,000 to $1 million, occasionally investing in follow-on Series A and B rounds.
Talk a bit about what kinds of companies do you like to invest in?
Sure. We invest in technology and technology-enabled service companies. Typically, we're pretty open-minded. I had some experience in B2C as well as sort of B2B, so we will invest in B2B and B2C. I would say the most common business models that we tend to see are more, enterprise SaaS, as well as online marketplaces, and every once in a while, it's consumer or social.
Okay. And define for us seed investing, because, I'm sure you remember in the earlier phase of venture capital, for me, in the mid-90s, the beginning of the internet, it was seed and Series A. Today, it's pre-seed, it's friends and family, pre-seed, seed, post-seed, pre-Series A, Series A, small Series A, large Series A. The seed capital investing has, fragmented. So what is your world view of seed investing? And most importantly, what do you like to see as proof points in the deals that you are comfortable going into? And maybe you want to take it as B2B and B2C separately.
Yeah, I think for us, what we mean by seed stage is we're looking for startups that are post-product launch. And I always think of, a startup's journey going through, different phases. The earliest phase I consider to be kind of experimentation and incubation. And we don't typically invest in that stage, but rather we're looking, post-product launch as a startup is kind of an early scale-up or growth mode. We're looking to see evidence of at least one scalable customer acquisition method. And so that's really what we mean. Often the companies we invest in are, somewhere between, $10,000 in monthly revenue, or maybe as much as $100,000 in monthly revenue. But we don't really care so much about how much revenue they have. It's more about the qualitative aspects. Do they have scalable customer acquisition? Is it something they can repeat and show us? So we're a fund that is largely started by founders for founders. We have about 40 of the most successful founders and operators in our surrounding region who have come together to launch this fund. And we think that's, so from that standpoint, the founders involved in our fund have all scaled successful companies across different industries and verticals with using technology. And so, we're really, looking to share kind of perspective on scaling, from actual entrepreneurs who have been there and done that before.
We can't hear you, Rob.
Oh, can you hear me now?
Yes.
Oh, sorry about that.
So, what is the situation in the Minneapolis area for the kind of companies that you're looking for? What is the scale of the deal flow? How active are the entrepreneurs, etc.?
Yeah, so I would imagine that, Twin Cities is like many cities in the world that are maybe kind of got a corporate mindset. We actually have the largest amount of Fortune 500 companies per capita in the U.S. And so that is sort of kind of, I would say our schools and universities over the past decades have tended to skew more towards management of, classical management in terms of education. I think more recently there's kind of a surge in more, startup management and innovation processes and practices from the schools and universities here. On the funding side, we have the second largest by cities in the Midwest. Chicago ranks number one for the largest number of first round fundings annually. Chicago produces something like 150 per year of first round funded companies. The Twin Cities is actually second, coming in at around 40 over the last couple of years. And, obviously, there's a much bigger gap between Chicago and the Twin Cities than the Twin Cities and the next 10 to 20 cities. But it's pretty healthy. We're pretty dominated by healthcare and life sciences, medical device. Although there's a growing group of sort of software, oriented investors here, including Great North Labs.
So, if you were to, assess how many companies in your sweet spot are operating at this point, how many would that be?
I think in the Twin Cities, it's in the dozens, maybe. Yeah, I would say, but we look at deals all around the region, so that's definitely in the, many hundreds.
Okay. All right. Interesting. Let's talk about a few of the companies that you have invested in. And as you're, describing some of the case studies, talk about when they came to you, what did they have, how did you find them, or how did they find you, and what was it about them that compelled you to write those checks?
Sure, happy to. So in terms of our current fund, because it's a relatively newer fund, our average hold is 16 months. So it's a little too early to kind of share the whole journey. But as I mentioned, I had a pre-fund track record along with my partner, Ryan, that goes back 10 plus years. So maybe I can share 3 stories from that. One of them is a company in Minneapolis called Field Nation. Field Nation is the North American leader in sourcing field IT workers. So also based in Minneapolis is a company called Best Buy. They acquired a services company that was also started here called Geek Squad. I'm not sure where everyone who's listening in the world is, but Geek Squad was a W-2 platform for field IT service work. And it's really become an anchor to the growth of Best Buy over the last decade or two as they transitioned away from pure retail model to services revenues. Well, Field Nation is like the Uber of field IT workers. They are the leader in North America. It's a 1099 kind of worker platform, and we funded that one about 12 years ago. The founder, Mainul Khan, is an immigrant to the U.S. He was actually my brother's computer science lab partner at a local state university known as St. Cloud State. He reached out to my brother actually to join as an advisor initially, and he was actually interning at another company we were involved with and going to school full time while starting Field Nation. We invested $100,000 along with bringing on one friend who joined for $100,000, and we helped Minua bootstrap that company for 7 years until he raised a $30 million kind of growth and recapitalization round. We've since exited much of our position to the private equity later stage fund. There are a couple of other ones. Atlanta, Georgia, we invested in a founder named Shahar, who started a music licensing tracking technology called Neurotic Media. We sold that company to Peloton in 2008. Peloton, of course, is the very famous cycling fitness subscription business that's kind of taken the world by storm, headquartered in New York. Neurotic Media, what we saw in that one was actually sourced by a friend of mine who was in corporate development at a kind of mid-sized, publicly traded e-commerce company here in Minneapolis. He mentioned Neurotic Media to me in passing 10 years ago as kind of an interesting startup. So that piqued my interest, and I called up Shahar, and we invested about, I think it was around 2008. And then the third one was Zencoder. Zencoder was people who upload videos to, say, TikTok, YouTube, or other online or mobile video services don't really appreciate the technology that goes into video encoding because of the work of companies like Zencoder, which we invested in 2010. Zencoder had the idea to build, if you remember, prior to 2010 time frame, when YouTube was kind of starting to take off, it was very challenging to encode a video on. It would suck up all your PC or Mac resources and be really cumbersome. So Zencoder created a cloud-based video encoding. We sold that to a publicly traded company about a year or two after we invested, Brightcove. We made that investment alongside Andreessen Horowitz and another famous kind of investor, Chris Sacca. So it's kind of interesting. Zencoder at the time was based out of Minneapolis and Madison, Wisconsin, although they went through one of the early Y Combinator classes. So those are a few examples. Actually in the Zencoder case, I knew John Dull, one of the co-founders, was just someone socially I got to know in the founder community in the city we live. So that was just kind of, that's how we sourced that one.
Okay. So a couple of questions emerge out of what you said, and I'll ask them in sequence. Let me ask the first one, which is, what is currently the dynamic of companies building out of Minnesota? You talked about Zencoder that has raised money from Andreessen Horowitz, was in Y Combinator, but what is the dynamic? Did they move to Silicon Valley, or they continued operating from Wisconsin, Madison and Minneapolis?
Initially Zencoder maintained their operating business here, but then I think they kind of received some pressures, this is about 10 years ago now, to kind of relocate to the Bay Area. And so they did do that. In the case of Field Nation, it's actually grown quite a bit more than, Zencoder ever even did. They maintain their headquarters, here in Minneapolis and continue to grow to this day. And so I think that, I don't know, I think that was probably one of the things, maybe one of the challenges of maybe working with like Y Combinator or, whatever. There were certainly some pressures there felt. I don't know if that's true today, but it certainly seemed to be the case being partners in Zencoder. But I think operationally most of it, yeah.
Sorry, I was going to say increasingly I think people are very, very comfortable with companies being elsewhere, and COVID has just accelerated that trend. So that's why I was asking you this question more in a contemporary sense, not what happened 10 years ago. 10 years ago, the dynamics were very different. Silicon Valley still operated in the mode that we like our company headquarters to be here within, 30 minutes of drive time. But I think that is changing, and what I'm trying to gauge is, since you work with Silicon Valley investors and companies in the Midwest, what are you seeing now in the last 6 months in particular?
Yeah, I completely agree with you. I think, in the last 10 or 20 years here in the U.S., there's been a lot of efforts to build capacity around the country, including here in the Twin Cities and the surrounding region. We now have a number of early stage funds. We have, the Twin Cities, by way of example, has over 20 accelerators. You don't need to go to Y Combinator. Techstars has multiple programs in the Twin Cities. Probably the most dominant accelerator in the Midwest is actually nationally ranked, I think, just around 10 is an accelerator program called Generator. And so, you can get the benefits of the mentorship and things from accelerators. And we certainly have no shortage of large corporates if you're selling to the enterprise or what have you. So I do think, that's what's changed. I started my company when I was 20 years ago. And, the capacity to support us was very, very weak, in the early 2000s. And that's, to the benefit. And I sense that probably this is true around the world, as pointed out. Like, I think there's much more willingness, to kind of support companies wherever they may be these days.
Yeah, and the thing that is very encouraging right now is that, as you pointed out, your preference is to invest in companies that have already achieved product market fit and are kind of in the early growth stage. Silicon Valley investors, especially if they're investing in companies elsewhere, they all have that mindset. They all want product market fit already, having been achieved, and they want to see an early growth stage company. So, and that is a lot cheaper to do outside of Silicon Valley than in Silicon Valley. It's very, very difficult these days in Silicon Valley to do bootstrapping. So if you're expecting that the company would have bootstrapped to a certain degree of, traction, that is not so easy to do in Silicon Valley. So
I agree. I saw some data that kind of reflect. Oh, go ahead.
Yeah, no, go ahead. Please finish. I was asking another question, but go ahead.
I was going to say I saw some data that reflected this in PitchBook. I think from Q1 2020 this year, that the median kind of seed round in the entire U.S. was about $9 or $10 million was the valuation. Our median valuation, we've done 22 deals now in the last 3 years, has been $5.5 million, so almost half. And I don't think it's because, and actually I don't think it's a detriment of the founders necessarily. You might think, why are they valued lower? Almost half of the the national average, which is obviously dominated by the coast. I think the cost of living drives much lower, salaries and operating costs in general. And so you end up with, most of the founders have the ability to maintain higher ownership when they're based out here than, say, San Francisco or maybe New York. So I think it's actually a great place to start a company these days.
Yeah, and here in 1Mby1M, we are huge believers in bootstrapping, as you know. So we very much encourage people to bootstrap first and raise money later. I think it creates much healthier term sheets and much healthier trajectories, but it is hard to do in such expensive cost structure situations. So my other question out of what you said is about the structure and strategy you're following for your own fund. You described a couple of case studies where you exited into follow-on rounds of funding, like the 30 million round, you exited into the 30 million round. So talk a bit about how you're thinking about, early exits and not playing this game of building unicorns and blah, blah, blah.
Well, there's kind of a couple of maybe points to unpack. I think, number one, we have set aside 50% of our fund for reserves and follow-on round. So of the roughly 24 million, I think about 12 million is for reserves. And even beyond that, we have a very active investor base. We can create special purpose vehicles if we desire to continue to back our portfolio companies. But I do think the unicorn kind of mania is a little bit overhyped. I think capital efficiency is underhyped.
I'm a little bit overhyped.
Yeah, I think so. We bootstrapped a company out of the dorm rooms to 70 million in revenue and 10 million in EBITDA. It did take us 12 years. Manuel Khan, I can't share his sales figures, but they surpassed our own. He bootstrapped it for 7 years. I think for us, though, when we think about exit, it's more about, it has more to do with the what we think is the possible growth rate of the investment. If we're looking for things that can kind of outgrow, what you can find in public markets. So things that can, typically grow 50 to 100% over a sustained period. And most of these startups, as they kind of mature and maybe get to the latter part of their growth stages, you're going to start seeing their growth rate slow down. And so that's when we will usually look to, in the case of, for example, Nation, we didn't take a full liquidity. We still have some ownership, but, we'll take some chips off the table. And I think that's all healthy. I actually think we have that's another thing that's evolved the last 10 years. There's a more vibrant secondary market. Later stage investors seem more willing to acquire, to kind of clean up the cap table. And even beyond that, investors seem more interested in participating in secondaries. And I think you see this also as one reason why the IPO market has sort of been pushing later and later and later. And, you see these mega IPOs now. It's because and I think this is all very healthy, right? To have more liquidity options. And I even think that's true for founders. Many times founders are able to take some liquidity or early employees from their, stock options or what have you. And I think that's all really healthy to kind of just help them with their own risk and personal well-being.
Yeah. And, these larger funds can start investing only at like 5 million, 7 million check sizes, which means that they're, coming in much later in the game. And it takes a while to get that early bootstrapping phase going. And the investment world is completely segmenting into the ones who play in that early stage versus the ones who play in the later stage. And I think the phenomenon that you're describing I'm seeing more and more of that, is that, people play the early stage and then exit into the Series A or Series B, and that's a perfectly fine fund strategy for a small fund.
Yep. Yeah, I
All
totally
right.
agree.
Great. Good to have a view into your part.